What is up everyone, and welcome back to the channel. Today we are talking about another crucial aspect of trading, which is liquidity. We're going to be covering how to spot liquidity, how to spot fair value gaps and liquidity voids and everything like that, and most importantly how to actually implement this into your trading strategy. So let's jump straight in. What actually is liquidity? Well, in simple terms, liquidity simply refers to how easily an asset can be bought or sold in the market without affecting its price. The more liquid an asset is, the easier it is to trade. Now there is two main types of liquidity. If I move on here, we have buy side and sell side liquidity. So usually how liquidity is created is by many orders being placed at one specific area. So here on sell side liquidity, for example, we can see that many orders are being placed at this key level as we constantly are getting bounces. But the key area to look for is when we actually sweep this liquidity. Now this is called sell side liquidity. All of these lows are sell side liquidity. So on equal lows, we usually need to wait for a sweep and then we'll see a move up. And for buy side liquidity, it's the opposite. We will be getting equal highs, like here, multiple orders are being built up, stop losses are being placed at the highs and a bit above, and then we sweep those highs, we clear those stop losses, and we have the move down. Now the key reason for this occurring is that large institutions need mass liquidity in order for them to place their orders and in order for those orders to be actually hit. So if many people are placing their buys right here, they have all of their stop losses below. When those stop losses get hit, that's additional liquidity going into the market, allowing big institutions to actually buy up that liquidity, and then they can follow the move up. The same goes for buy side liquidity. When there is a lot of stop losses being placed above here, those stop losses are hit, the institutions are allowed to sell because there's mass liquidity in the market and the price moves down. Now here I have an example on the chart. So here we can see there is sell side liquidity because we have these equal lows, we sweep the lows and we have a move up. Now obviously this is in a downtrend, so the move up is minor, but nevertheless we sweep these lows with this huge candle and then we have a move up. Now here's a better example of buy side liquidity. So you can see we created equal highs, we swept these highs with the wick, and then we followed with a huge move down. Now we move on to spotting fair value gaps or liquidity voids, whatever you want to call them. So the very first step is to find three major candles in the same direction. So here for example we're going to use a bullish fair value gap as an example, and we can see we have three major candles to the upside, all of which are bullish candles. Then what we need to do is we draw on our rectangle tool from the previous candle wick high to the next candle wick low, and this right here would be our fair value gap. Then we can just draw it out and you will see that price will respect this area very well. Again, we respected it, the price here once and here again twice. Obviously here we dropped a bit below the fair value gap, but nevertheless price still maintained above it, not closing a candle below, and we continued the move up. Obviously afterwards we did break down, but nevertheless it maintained this range right here. So this is what a bullish fair value gap would look like. Now usually you'd be wanting to enter trades from the bottom of the fair value gap, but what I've noticed in my trading experience is that we can also come to just tap the fair value gap at the top like we did here, or also we can fill half of the fair value gap like this. For example, we can, if we draw on the Fibonacci tool, what we can do is we can select simply just the 0.5 area like so, and we can use this as our entry because sometimes we will also fill 50% of the fair value gap and then see the reversal. Now here we have an example of a bearish fair value gap. We can see we have many candles going down all in the same direction, but we're going to use these three candles or these three candles right here. So we will draw on our box tool from this candle wick low to this candle wick high right here, and this will then be our fair value gap. Now again, price respects it, not fully because we obviously went slightly above, but as long as we don't break any of the highs as we talked about in our previous videos, then it's all okay as the trend is still moving down. But again, price will respect this area as a sort of resistance level, and you can find your trades from the bottom of the fair value gap, 50% of the fair value gap, or even 100% fill of the fair value gap. Now the easiest way I remember these fair value gaps is that they work as sort of magnets in the market. Once we get these voids, price will always come back to fill these gaps before we see any move in the next direction. Here we kept moving down, but we came back up, filled the fair value gap, got all of those orders in, and we continued the move down. Now, some lower probability fair value gaps would be where we don't have the 3 candles in the same direction, but price respects the fair value gap nonetheless. Like here, for example, we have 3 candles, but this candle right here is a bullish candle. But if we draw on a fair value gap here, we can see that price will still respect it, and we actually fill 50% of the fair value gap perfectly before we see this large move down. Now you can see just how well these fair value gaps work, as if you would have seen the fair value gap here, you could have placed your entry right here, placed your stop loss at the previous high, and then your take profit at the previous low or swing low right here, and you would have seen a nice profit and around a 1 to 1.89 risk to reward ratio. Now, whilst that's not the best, you can still see that the entry was perfect. We didn't go into any drawdown, and the trade hit the take profit nicely. Now, the key thing to also remember with fair value gaps is that once they do get filled 100% of the way, that they are no longer valid. Fair value gaps do not work similar to order blocks or supply and demand areas where they can be hit multiple times and the price will still respect that area. Fair value gaps, once they are fully filled, they will no longer be applicable for entry. Now here is how I would use liquidity and fair value gaps in a trade. So we see we're in an uptrend, we create these equal highs right here, from this high to this high. There's a lot of orders right here, selling orders, hence why it's called buy side liquidity. Then we clear these orders by sweeping above the highs, clearing these stop losses, because when short stop losses are hit, they turn into buy orders as those shorts need to be bought up. This then gives liquidity to institutions and banks and hedge funds and so on, and then they're able to sell in the market because there's so many buy orders giving them liquidity. Then we see a huge move down. This will usually result in a change of character from this low right here, and during all of this there will usually be a fair value gap right here. Then once we see a slight retracement, we need to find our entry either at the 50% of the fair value gap or 100% of the fair value gap. I don't really like using the bottom or the top of the fair value gap, simply because I don't see how that would really work in the market, as the fair value gap is essentially filled with orders and those orders need to be hit in order for it to be mitigated. But if we just hit the bottom of the fair value gap, then not many orders are being hit and it doesn't really work. So I like to use either 50% of the fair value gap or 100%. Now here in this case we can say we use 50. We want to place our stop loss at the previous high and then our take profit at the previous lows, or if you see a demand zone or anything like that, you can place it right there. Then our trade gets hit and we continue the move down. Now this is usually how it will play out in a bearish scenario. Now here is how it would work in a bullish scenario where we look for buys. So we're in a downtrend, we see we create equal lows right here, lots of liquidity being built up as there is many buy orders here with their stop losses right below here. Then we clear that liquidity by sweeping these lows, and you can see here all of that liquidity has then been cleared. We see a huge move up. This is where all of the institutions, hedge funds, banks, everything like that enters, hence for the huge move. We create a change of character from this high right here, insinuating that we are now creating a bullish uptrend. Then once we have a slight retracement back to the fair value gap, as the change of character will usually be created with a fair value gap, we can look for our entry either at the 50% mark again or at the complete fill. Now again, you can do 2 entries as well, at the 50% mark and also at the 100% mark. It just depends on your strategy and how much you want to risk. I think that's usually the best scenario to do, as you get 2 entries, a dollar cost average in entry and the main entry at 50%. Not only will that allow you to get the best possible price, but it will also allow you to catch the maximum amount of trades, as sometimes we might not fully fill the fair value gap and we might only fill 50% of it. So once we get the 50% mark, we place our stop loss at the previous low and our take profit at the next high or supply zone. Now a key thing to also remember is that this strategy is not a 100% win rate. So sometimes you might get your stop loss hit and you might turn into the liquidity. But what is key to remember is that if you backtest a strategy with a positive risk to reward ratio and you find the win rate that you need, I know a lot of people that trade a similar strategy with a 30-40% win rate. Most of their trades are losses, but the ones that are wins are such high risk to reward ratio that the one win would turn a profit from 3 losses or even more. That's a key thing to remember. Now, if you did enjoy the video, make sure to leave a like and subscribe, as it does help out a lot. Also, make sure to check out the Discord down below, as we are sending out trades and also have a lot of learning info and a lot of strategies for you to learn from in there. Thank you all for watching. Goodbye, guys.